Welcome to This Explainer. Today, we're unraveling a genuinely shocking financial mystery. How does a massive European renewable energy company, one that's literally helping power the continent's green transition, go completely broke practically overnight? We're looking at the sudden, breathtaking collapse of GoldenPeaks Poland Holding. It's a story that moves from the pristine boardrooms of global food giants straight into a Texas bankruptcy court in just a matter of months.
Okay, let's dive into this. When GoldenPeaks and its 39 affiliated entities walked into the U.S. bankruptcy court for the Southern District of Texas in late May 2026, they were carrying a staggering burden, $952 million in total funded debt. We're talking nearly $1 billion in obligations suddenly hanging over a company that, at least from the outside, looked like it was thriving in a booming green energy market. It's a monumental figure, right? And it immediately makes you wonder how a business in such a high-growth sector could dig a hole quite this deep.
But you really have to contrast that massive debt with this painfully tiny number, 1.1 million euros. That is all the free and clear cash they had left in the bank to actually run the business when they filed for Chapter 11. The sheer scale of this financial wreckage is honestly hard to overstate. A near billion-dollar debt load offset by essentially zero operating liquidity, that's a recipe for instant corporate death. So to understand how a gap this massive opens up, we really need to rewind just a few months to see what everyone else saw.
Which brings us to Section 1, the illusion of success, featuring blue-chip clients and mega deals. Because just months prior to this spectacular bankruptcy, there were absolutely no outward signs of distress. In fact, everything pointed to a company that was totally dominating its space.
Think about this. In late 2025, and as recently as February 2026, GoldenPeaks was out there aggressively signing massive power purchase agreements. They partnered with global heavyweights. We're talking Mars, Cargill, Nestle, Hankook Tire, and Auchan. To give you an idea of the sheer scale here, an October 2025 deal with just Mars and Cargill alone was designed to spur 224 megawatts of new solar capacity in Poland. These solar farms were expected to generate enough clean energy to power an estimated 200,000 households every single year by 2027.
And GoldenPeaks wasn't just some scrappy, ambitious startup selling concepts and blueprints either. They had a huge physical footprint. They boasted 664 megawatts of fully operational solar capacity across Poland and Hungary, with another 592 megawatts actively in construction and development. They were a major player with very real, functioning infrastructure serving some of Europe's most carbon-intensive grids. This was real steel in the ground, generating real power.
Section 2. How it all unraveled, anatomy of a failure. So, how on earth does a company with operational assets, a gigawatt pipeline, and blue-chip clients crash into a wall so hard? Let's shift into corporate forensics mode for a second and investigate the mechanics of this collapse.
And this brilliantly illustrates just how insanely fast the bottom fell out. The sheer speed is breathtaking. In October 2025, they're signing landmark renewable deals making global headlines. By January 2026, a crucial subsidiary completely collapses. By May, they're filing for Chapter 11 protection, and by July, a lead bidder is already stepping in to take over the assets. This was not a slow, grinding decline spread out over years of mismanagement. No, this was an absolute freefall. The dominoes actually started falling with a wholly owned affiliate called Spectris Energy. Now, what's crucial to understand here is that GoldenPeaks, the parent company, had zero direct employees of its own, literally none. Spectris handled all the engineering, the construction, the day-to-day operations. But in January 2026, Spectris got crushed by a perfect storm: rising component costs, higher interest rates, and severe currency swings. Eventually, it got so bad that Polish tax authorities actually froze their bank accounts. When Spectris went completely dark, suppliers walked away, leaving the parent company utterly paralyzed. Just think about the absurdity of that for a moment. A massive solar company with absolutely no one left to actually run its solar farms.
And as if that internal crisis wasn't bad enough, Poland's aging power grid simply couldn't absorb all the energy being generated during peak times. So the transmission system operator began restricting how much solar power could legally feed into the grid. This meant GoldenPeaks had perfectly operational solar panels generating electricity that legally had nowhere to go. For a company carrying nearly $1 billion in debt, being starved of this expected, absolutely essential cash flow was a fatal blow.
Internally, the governance was, well, it was an absolute mess. They scrambled to sign an emergency operations deal with a firm called Urgy just 16 days before filing for bankruptcy. But honestly, it was way too late. Restructuring experts later uncovered a company that was operating with multiple chief financial officers who had overlapping, super confusing mandates. There were 0 standalone financial statements for the debtor entities, absolutely no budget reporting, and totally fragmented financial controls. The business was flying completely blind.
This quote from Edward Manning, he's a managing director at the restructuring firm Alvarez & Marsal, perfectly summarizes the grim reality. He noted in court filings that some GoldenPeaks units unraveled precipitously and liquidity evaporated within a matter of weeks. The violent, sudden speed of this financial death spiral is exactly what makes this specific case so astonishing to financial analysts and industry insiders.
Which brings us to the complex financial maneuvers that follow a collapse of this magnitude. Section 3, the Bankruptcy Playbook. Enter Brookfield Asset Management. Now, to really understand what happened next in the Texas Bankruptcy Court, you need to know this specific term, a stalking horse bidder. In a corporate bankruptcy, this is basically an initial bid chosen by the bankrupt company to set a firm floor, a minimum price for its assets. It essentially stops other opportunistic investors from swooping in with lowball offers during the court-supervised auction. Any competing buyer entering the fray has to beat this established baseline number. So, the crucial point is how perfectly Brookfield positioned themselves to absolutely dominate this auction through 3 methodical steps. Going into the bankruptcy, they were already the controlling shareholder and the junior pre-petition lender, owed about $294 million. Then they stepped up to provide a $162.8 million debtor in possession or DIP loan. This is basically emergency funding to keep the company's lights on during restructuring, which, of course, gave Brookfield even more leverage over the estate. Finally, they won court approval to use at least $114.8 million of the debt they were already owed to place that initial stalking horse bid we just talked about.
The structural advantage the setup creates is just massive. Unsurprisingly, other creditors, like the asset manager Berenberg, fiercely oppose this dual role of Brookfield acting as both lender and lead bidder. But Judge Alfredo Perez rejected that argument, ruling this setup was perfectly legal under bankruptcy law. Because Brookfield is using existing debt as credit for their purchase price, they don't actually have to deploy new capital. Any outside competitor trying to outbid them, well, they have to write a massive, fresh cash check just to get a seat at the table.
To fully grasp why Brookfield is making these aggressive moves, we really need to zoom out for a second. Section 4, the broader decarbonization strategy. Why Eastern Europe matters.
Back in 2021, Brookfield launched a massive global decarbonization fund, accumulating over $40 billion specifically earmarked for sustainable infrastructure and renewable energy investments. When you have access to a fund of this sheer size, distress in the market isn't just a crisis for the industry, it's a highly orchestrated strategic opportunity. It allows them to deploy capital efficiently and scoop up valuable green assets at a steep discount. And this move builds perfectly on their existing playbook. That same year, 2021, Brookfield paid $175 million for a stake in Polenergia, which is another highly prominent Polish renewable energy company. So taking over GoldenPeaks isn't an isolated random deal. It directly aligns with their intense focus on expanding their solar footprint in Eastern Europe, a region that is aggressively scaling up capacity right now to meet strict European Union renewable targets. Brookfield already has the local market knowledge and the operational synergies just waiting to be activated.
Which leaves us with this final, truly vital question to ponder. As the green energy boom accelerates worldwide, who is ultimately going to own the infrastructure when the dust settles? GoldenPeaks built something very real, 664 megawatts of operational solar power and blue-chip contracts with some of the biggest food brands on Earth. The original developers might have gone bankrupt thanks to a fragile corporate structure and harsh macro headwinds, but the solar farms, they remain intact. And in the end, it's the massive private equity funds that are perfectly positioned to claim them. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.